Hi, everyone, and thank you for joining us today for our Q4 review and outlook for calendar year 2022. My name is Jeff Ingram. I am the Managing Director of our Portfolio Strategies Group here at Manning Napier. I've probably spoken with many of you all at some point over the years, but if not, certainly look forward to speaking with you today. Joining me here is Ebrahim Busheri. Ebrahim is the Director of Investments and Head of our Research Department at Manning & Napier. Ebrahim, welcome.
Thanks, Jeff, and thanks to all of you for joining us today. Look forward to the dialogue.
So I'm going to kick things off with a brief overview of market performance during Q4, followed by some comments on our own investment strategy performance for both Q4 and calendar year 2021. I will then hand it off to Ebrahim to cover our outlook for 2022. And as always, we encourage your engagement and want to be sure we're addressing the topics on your mind. So please feel free to use the chat functions or the Q&A functions on your screen to submit any questions you have for us, and we'll address those at the end of our presentation. I'd like to say that it's always nice to be able to lead with good news. So let's start things off here with a quick look at the US equity market performance in Q4. The S&P 500 ended the quarter on a high note, rising a little over 11%. Other equity markets were strong as well, with smaller companies and developed international stocks posting positive returns. The only exception in the public equity markets was emerging markets, which closed slightly lower for the quarter. And as you see here, I think the fourth quarter was notable because three of the biggest issues that will continue to weigh on markets this year really made their presence felt during Q4, and that being inflation, which registered a 40-year high, monetary policy, with the Fed accelerating its bond tapering and increasing the number of rate hikes expected next year. And lastly, the latest wrinkle of the COVID pandemic as the Omicron variant emerged immediately after Thanksgiving. And yet, despite these headwinds, as you can see here, the S&P 500 closed the year once again making new all-time highs. And really in a testament to the what I'll call the steady strength of the market all year long, the S&P 500 ended nearly 30% higher for the year and posted 70 new all-time highs along the way, which is one approximately every fourth trading day. And really, it's a good thing that the equity markets were as strong as they were last year, because fixed income proved to be a challenge. The solid blue line here is where Treasury yields ended the year compared to where they began the quarter, with the dotted gray line, and then the beginning of the year, if you look at the solid gray line. And just starting with the change for the quarter, the 10-year you can see here remains sort of anchored at that 1.5% level through the quarter, while the short end of the curve increased about 20 to 50 basis points as the market started to price in the accelerated Fed rate hikes. And the long end of the curve actually declined a little bit for the quarter, but for the full year, rates increased across the board, ranging from 25 basis points on the 30-year to nearly a full percent on the 5-year. And that pushed the broad fixed income market to a negative return for the calendar year, which is only the fourth time that's happened in over 40 years. And spreads outside of treasuries remain rather narrow as well. You can see that in the bottom right-hand side of the screen here. So attractive all-in yields have been tough to come by in the fixed income markets. And Ebrahim, I know this is one of the biggest challenge to investors today, with low starting yields in anticipation for rates to rise further from here. I guess maybe just briefly, what are your thoughts on the fixed income market and any advice you would give to investors or advisors on how to approach investing in the market right now?
Hey, Jeff, I'd highlight that we've gone through a fairly long period of time with interest rates declining, and that's been a conducive environment for fixed income. And so we've been fortunate to be able to deliver good fixed income returns for our clients. I think the combination of the things you highlighted, low interest rates, inflation starting to show signs of coming back, it's running high currently, and that leading to likely multiple rate hikes in 2022. Does make for a more challenging backdrop for fixed income in 2022. And I would say in that environment, two areas that we continue to feel we can find some returns and we have some flexibility would be in the high yield area and also in the unconstrained bond area that we have.
Yeah, I think that'll be sort of a key topic throughout this presentation is entering a more challenging market environment, having as many tools at your disposal as possible. And obviously those are two strategies where we do have many tools. So turning now to performance, our multi-asset class portfolios generated positive returns, but underperformed their respective benchmarks during the quarter. The underperformance was attributable primarily to our allocation to communication services sector, which was it ended up being the worst performing sector during Q4, is actually the only sector to deliver a negative return. If you look at that area, it's comprised primarily of our holdings related to gaming, social media, traditional media, and digital advertising. And on top of that, a few of our payments companies also underperformed during the quarter as well. I just note that many of these stocks have been significant contributors to performance over the years, including for the full calendar year in 2021. And we don't see the slight pullback as a cause for concern for these stocks. Turning now to the core equity strategies, they lagged their benchmarks as well for the quarter. The themes that I just spoke about were broadly similar as the prior slide, where stock selection in certain areas like gaming and digital payments hurt relative performance. For the US equity portfolio, actually Apple and Tesla in particular had really strong quarters. And as two of the largest holdings in the benchmark, it ended up hurting some of the relative performance as we don't own those two stocks in any of the US portfolios. For the non-US and global equity portfolios, we also saw underperformance attributable to a few healthcare stocks owned in those portfolios. I think the important thing to note is just that none of these market movements really prompted any major change in our thinking or positioning for these stocks. And in some instances, we actually took the declines as an opportunity to increase our exposure. Lastly, as we turn to additional equity strategies that we manage, our disciplined value strategy, which focuses on high quality companies with healthy free cash flow and dividend yields, it outperformed its benchmark for the quarter thanks to that portfolio's large to mega cap and quality bias. Turning to an entirely different equity market, the Rainier International Small Cap Equity strategy delivered strong relative performance for the quarter as well, which propelled the strategy ahead of its primary benchmark for the year. As historically been the case for that portfolio, the outperformance was driven by strong stock selection from that Rainier team. Focusing now on performance for the full calendar year here, starting with the multi-asset class portfolios, they all delivered strong absolute returns and outperformed their respective benchmarks for the year. The primary contributors were asset allocation, as those portfolios were all slightly overweight equities for the year, and strong performance from the energy and real estate areas where we had overweight exposure and were two of the highest performing sectors in the market last year. Ebrahim, for a minute here, I guess, as we look at full year performance for our flagship multi-asset class strategies, what stands out to you and the department as you reflect upon 2021?
Jeff, when I think of our multi-asset class strategies in 2021, I think in some ways we built on what happened in 2020 as well, which was another year of superior both absolute and relative returns. We've had a relatively volatile environment, and that's enabled us as an active manager to use really all of the things that are in our toolkit. So I'd highlight three different areas that we have to provide performance for our clients. We're fortunate to be able to use all three for positive returns in 2021. Similar in 2020. The first one would be asset allocation that you touched on. We were overweight equities in portfolios over the past year. And with a rising equity market, it contributed meaningfully to our outperformance. And then the second and third lever that we have is the ability to have sector and security selection, both in fixed income and also in equities. And then similarly, if I take each of them in the fixed income markets, We outperformed last year again. A great job by our fixed income team navigating a difficult environment. And then lastly, on the equity side, similarly outperformance. And I think you highlighted one of the areas I think that took place, which is going back really to 2020 with the downturn that took place in March. We shifted from being underweight commodities and energy in particular to be meaningfully overweight. And energy was a strong contributor to performance in 2021. So really asset allocation, security selection, and sector positioning in fixed income and equities all contributed to the performance you see on this page.
Yeah, and just picking up on that last note here, turning to the core equity strategies, they too delivered strong absolute returns for the year and all outperformed their respective benchmarks. And as you mentioned, energy exposure, once again, the primary contributor to performance during the year. Within the US equity portfolios, the energy sector was up over 50% last year, top performing sector by far in the US equity market. And we also received strong contribution from many of our profile names in the portfolio related to cloud computing, digital advertising, and semiconductors, to name a few. For the non-US and global equity portfolio, the energy sector, once again, the best performing sector, but it was really more notable the stock selection within energy that stands out. You know, our energy stocks were up over 70% as a whole in the non-US equity portfolio as an example. And it was stock selection too that was a contributor. It actually came from, I think one of the great things to point to here is when you look at the contributors in the non-US equity portfolio and the top contributors, it actually came from each of our stock selection strategies. So we had the profile names contributing to performance. Two of our bankable deal investments in particular were strong contributors, in addition to the hurdle rate performance that we achieved for our clients in the energy sector stocks that we referenced. And just lastly here, turning to our specialized equity strategies, Disciplined Value delivered a strong absolute returns, but trailed behind its benchmark. This performance is entirely in line with expectations as the strategy, excuse me, sorry, we're running a little COVID daycare here, excuse me. My apologies. I'm guessing many on the line are probably in a similar circumstance or situation. I apologize for that. So just turning to the specialized equity strategy. So Disciplined Value delivered a strong absolute return, as you can see here, but it did trail its benchmark, which is performance that's really in line with expectations. That strategy tends to lag when market returns are exceptionally strong, as was the case this year, especially so when many of the areas that contributed to performance in the large cap value space in 2021 came from the relatively beaten down, more cyclical areas like energy and financials and real estate, as opposed to the more high quality areas like consumer staples, where Disciplined Value tends to be overweight. And then turning to Rainier, the strong performance in the fourth quarter led the strategy to outperform its benchmark for a fifth year in a row. And I think this year in particular is notable. The strategy's high quality growth bias was confronted by an environment in which value companies led growth by more than 3% for the year from a style perspective, and has been the case over the strategy's history. Strong stock selection was the primary contributor to performance once again this year. So Ebrahim, as we before we maybe turn the page and the calendar year to 2022, anything else that you'd like to highlight from the research department in 2021?
Jeff, you just covered relatively broad-based outperformance that we were able to deliver for our clients, from our multi-asset class portfolios to our equity strategies like US equity, non-US equity, and global equity, and also our Rainier international small cap product. If I were to try to point to common themes across all of them, I would say as an active manager, one of the things that we take pride in is that we are a very kind of process-driven, disciplined firm with a strong emphasis on risk and risk monitoring and making sure that we are aware of the risks that were taking place in the portfolios. It's really helped serve us well over the past couple of years. You saw this play out in 2021, and you also saw it play out in 2020 as we've navigated volatile markets. And the second area that I'd point to, which is how we've built on our risk framework over the last few years, is by incorporating ESG factors, environmental, societal, and governance factors into our risk framework. With all of our strategies, we've incorporated ESG. We take it into account at the analyst level and at the portfolio management level. And so that's a really continual refinement of our risk monitoring process.
Great, thanks, Ebrahim. And I imagine we'll be talking about those things as we enter 2022 as well. And as we look out to this current calendar year, one of the things I've heard the research department discussing frequently is this idea that we are moving past the point of peak liquidity conditions. So what exactly does that mean, and how will it impact markets moving forward?
I'll start, if I could, Jeff, with fiscal policy. We've really seen an unprecedented level of fiscal policy or deficit spending taking place in the US and across the globe. So what you see on this chart specifically is the US federal budget deficit or surplus as a percentage of GDP. And as you can see, last year, it was the highest that we've had going back in this case to 1970. It's actually higher even if you go further back. This comes from basically all of the different spending packages that were specifically related to kind of COVID stimulus measures, stimulus checks to individuals, spending bills at the local government level, extra unemployment benefits that took place. They were a tremendous tailwind and a beneficiary for the healthy economy. Just to put it in perspective, the amount of stimulus spending that took place on a per capita basis, what happened during COVID is 5 times as much as that was spent during the global financial crisis, and 3 times as much on a per capita basis as was spent in the New Deal going back to the 1930s. So really, we've seen a tremendous positive stimulus to the economy, and we expect, as you see on this chart, this to start to taper off. We don't think stimulus measures of this magnitude can be sustained. And as that happens, the growth that we will see in the economy, and I'll touch on in a minute, and in the stock market's earnings will start to slow down over the next few years. The next chart shows it in terms of real GDP growth. So similarly, you see here in 2021, helped by the stimulus measures and also recovery from really depressed growth in 2020, we saw a strong year of GDP growth last year. Really one of the strongest years we've seen in multiple decades. This growth, for the reasons I've highlighted, will start to slow down. So more than 4% growth over the past year, slowing to 3+%, 2+%. And eventually what we think will happen is the economy has been, as all of you are familiar from these webinars over the years, we've expected relatively slow 2-ish% growth, and we expect that the economy will return to that over the next few years.
Great. So we're moving past the point of sort of peak fiscal stimulus, and picking up on your first point there, regarding that stimulus that was injected into the market. There's no doubt that spending had a massive impact on the inflation numbers we're seeing now, which I mentioned earlier have been the highest consumers have faced in over 40 years. You can see this sharp sort of tick up higher here on the graphic at the top relative to the relatively mild inflation that we had come accustomed to for the 25 years leading up to this time period. We really saw a lot of interesting things happening under the hood with these inflation figures. So you had consumer spending between goods and services shift pretty dramatically towards goods, as many of the aspects of the service economy, whether it was travel or leisure or dining, were restricted or limited during the pandemic. And the goods spending really put a lot of pressure on supply chains right across the globe, many of which themselves were either not prepared for that surge in demand or faced capacity limitations due to health and pandemic related shutdowns. You also had relatively small components of the inflation basket, like automotives, so used cars, new cars, rental cars, making outsized contributions to the inflation measure. And then in some cases, it was year over year comparisons when the economy was shut down in the year prior, that made some measures sort of difficult or impossible to truly calculate. So taking all those things together, I think many of the inflationary pressures that we faced last year and expect to face at least through the first half of this year have been more cyclical in nature. So the expectation for the out years beyond 2022 is for some of the more secular forces, whether it be demographics or globalization and technology. Those have been the things that have really driven inflation lower, and they're likely to reassert themselves. And so you can see that on the bottom of the chart here, where expectations for inflation to continue to hover around, say, 5% this year, but the rest of the numbers listed here indicate what the market is expecting inflation to average over the time period that's noted below. So in all cases, you can see it converges pretty quickly closer to the Fed's 2% average inflation target rather quickly here. So we've got this, impact of peak fiscal liquidity that's happening in markets right now, but it's a period that is, at least from a spending perspective, largely behind us right now. The other aspect, Ebrahim, monetary policy. So what are thoughts on what happens with monetary policy and its impact on the stimulative liquidity environment it's thus far provided?
Yeah, I touched earlier on fiscal policy. That's been a big positive for the economy, turning into less of a positive. And we expect the same to take place with monetary policy for the reasons that Jeff highlighted, specifically inflation, for example, being fairly strong. We expect monetary policy also to turn from being very conducive to the opposite direction. What you see here is that the market has now built an expectation that by the end of 2022, we will likely have 4 rate hikes take place from the Federal Reserve. So we are likely to see it starting relatively soon and building from 1 to 2 to 3 to 4 rate hikes. And I should also add that from a monetary policy point of view, we expect the Fed also to start to cut back on its balance sheet. And the combination of these two factors are likely to act as a bit of a headwind to growth, but also conversely cause inflation to start to come down over time. If I turn to the next page, I'll similarly build, if I could, on the fixed income side. The combination of low interest rates that we spoke about earlier and high inflation that I just referenced means that basically fixed income markets currently have negative real rates of return. The rates of return that you get in fixed income markets, in treasuries, for example, don't cover inflation, leave alone providing you with any real rates of return. Again, this is something I think over time, through the combination of higher interest rates and inflation coming down over time, is likely to turn this into a more positive story, but something that bears watching as 2022 progresses. I'll touch on one other factor, if I could, on this chart, while shifting over to just some insights on equities. I don't want us to come across as a negative story overall. Yes, we do believe some risks are increasing in the marketplace, both in terms of fixed income and in equities. But we continue to find many opportunities overall, and I'll touch on them. Speaking specifically to equities, I'll highlight a few different areas that we are starting to see some froth taking place in the marketplace. You see 9 different statistics mentioned on this page. And if I could, I'll just touch on a few of them. Information technology, you see in the top middle, is now close to 30% of the market. This is the highest rating that's occurred other than the tech bubble that took place peaking in March of 2000. Now, we do think that the information technology revolution this time is very different than what took place in the 90s. These are real companies with real sales and real earnings. But we have seen more and more of the market's money move into this area. I'll contrast that, for example, within the second row with what's happened in energy. Energy at its peak was about 16% of the S&P 500. It's now under 3% of the S&P 500. So again, just another sign that growth-oriented companies, disruptive companies have more and more garnered investors' attention. And areas like commodities or value-oriented companies, as people would characterize them, moving in the other direction. And if I could, I'll just point to one more data point on my end, which is what I've just outlined in terms of public markets has been replicated in many ways in private markets as well. So if you look at the amount of money flowing into private equity, it has caused the multiples that they pay when they buy businesses to just continually increase. Most recently at over 13 times EBITDA, an all-time high.
Yeah, all great points. I mean, for me, so we were calling this the tic-tac-toe boxes as we were putting it together. And, the details in each of the boxes provide a lot of the specifics. For me, it's really the aggregate message here that markets are more vulnerable right now. We've talked about fixed income being pressured by high inflation and rising interest rates. You've got equity markets that are stretched given the current levels of concentration and investor sentiment. I think liquidity remains an outstanding question here across many markets as the Fed starts to withdraw its support. Many banks have pulled back on their trading and balance sheet capacity, and more investors have moved into less liquid investments as they pursue potentially higher returns. I think, that all being said, one of the good things to highlight about last year is how those returns were generated in the S&P 500. So this chart breaks down the composition of equity market returns into earnings growth, dividends, and changes in market valuations or PE multiples. And you can see for 2021, S&P 500 companies achieved the highest EPS growth on record, with the operating margins growing more than 60% compared to 2022. So this was a combination of strong top-line revenue growth as pent-up demand that was, again, fueled by fiscal stimulus was unleashed as the economy reopened. And you had companies that were able to push more to the bottom line. As we look today, corporate operating margins are at all-time highs. So the end result ends up being a 30% return for the S&P 500. And that comes, as you can see, to the gray bar here below the line, is that valuations actually fell last year slightly. So it's encouraging to see that. It's obviously a little bit of a positive sign in that valuation multiples or multiple expansion had largely sort of fueled the market higher in the prior 2 years. But that's obviously a less sustainable source of returns over the long run. And as we talk about the long run, it's worth reflecting on the tremendous performance that investors have experienced, not just last year, but really for the past decade, and how much that their portfolios have benefited from this strong run of performance. So this chart shows the range of outcomes for the S&P 500 over rolling 1, 3, 5, and 10-year periods going all the way back to 1926. And the year-end 2021 figures are noted by the stars on each of the bars. So you can see longer-term performance ranks near the top of what's been achieved historically. So as we look to what we'll consider a more challenging environment across all asset classes, really this upcoming year, I think it's important to manage expectations and also provide this reminder of what's been achieved so far over the past decade. So I guess with that, Ebrahim, what would you say are sort of the three main messages you want to leave for our audience as we look ahead to the coming year?
Jeff, if I could pull all the different things that we've covered together. We spoke about fiscal policy not being as conducive going forward. So specifically, this amount of stimulus payments that have taken place over the past couple of years starting to slow down. The amount of deficit spending that's taken place over the past few years as a result of COVID starting to slow down. We've also similarly spoken about monetary policy, like fiscal policy, no longer being as big a tailwind as a result of, for example, inflation rising and multiple rate hikes that we see occurring in the marketplace overall by the Fed. So the combination of these factors, we think will cause growth to slow. We're not forecasting a recession, but we do think that growth will slow to much more sustainable levels in the economy and in terms of earnings growth as well. I'll also highlight, basically, we've gone through a multi-year period now of fairly extraordinary strong returns in equity markets. And as that's taken place, I mean, like 20+% returns really over the past many years. We'd similarly like to caution investors that we think that is not sustainable. And so we looking forward, we'd expect equity returns to be average to below average going forward. And then similarly, the combination of low interest rates to start, along with interest rates likely to increase, I think does not present a strong backdrop for fixed income returns. Now, you could take the combination of these three things that I've mentioned to be in a negative light, And in some ways, we do want to present our views of kind of slower growth and maybe lower expectations. But I want to make sure I leave each of you with many areas that we continue to be optimistic. Really, I think that the environment that we are entering now is really an ideal environment for an active manager. When you go through a period of strong stimulus, when you go through a period of easy money, when you go through a period of low interest rates, and really in some ways we've seen interest rates heading lower over the past 40 plus years. The impact of that on assets in general is it inflates all assets. So if you've owned equities, you've done well. If you've owned fixed income, you've done well. If you've owned real estate, you've done well. But in an environment that we think we are started to enter already now, we think being an active manager and selectively choosing the right stocks and bonds and other asset classes will make a much bigger difference going forward. If I could, I'll highlight a few different areas that we are finding opportunities and are still enthusiastic in our portfolios for you, our clients. Here we see 6 different sectors mentioned. And if I could, I'll touch on a few of them. Gaming. We've got investments that we continue to find attractive, both on the US side, Electronic Arts and Activision would be examples. And then multiple investments on the international side as well, including Ubisoft and Sony as examples. If I were to highlight payments as another area, for many years, we've had investments in companies like Visa and MasterCard, but we've really expanded into kind of broader areas as new areas have emerged. And companies like PayPal and companies like Square are things that we're optimistic about as well. And then lastly, if I could, there's a lot of emphasis and we have a lot of investments in terms of kind of more disruptive, faster growing companies like I highlighted, but kind of more traditional areas like food, beverage, and also household products continue to be an important part of our client portfolios, whether it be a Coke and a Pepsi in the US, or whether it be companies like Nestle and Unilever in international markets. Our discipline processes are really leading us to quite a few different opportunities in the marketplace overall.
That's great. Thank you, Ebrahim. So we're going to turn now to a brief question and answer session. Just as a reminder, if you have a question you'd like to ask, please use the chat or the Q&A functions on the Zoom panel. We did receive a few pre-submitted questions, so as you all are formulating your own, we'll address those first as the others come in live. And I think not surprisingly, a lot of the questions we received ahead of time were related specifically to Fed action, monetary policy, interest rate hikes. What impact is that going to have on markets? I think this chart is a helpful maybe visual as to what happened the last time the Fed started initiating more restrictive actions in the markets. So they did start hiking rates late in 2015, and they continue to do so in a somewhat measured fashion. And you can see the impact that that had on the yield curve, where it was primarily felt on the short end of the curve here. So you can see that interest rates increased from near 0 to over 2%. The effect it had on the long end of the curve was relatively subdued. I mean, the 10-year Treasury, it did increase about 50 basis points, about half a percentage point. The 30-year Treasury didn't really change all that much. I think importantly, the markets really didn't sort of implode from this action, right? It was a very measured approach that they took, very well sort of telegraphed to the market at the time. But what it did create, it created a more challenging environment for equity market returns. So if you look at that highlighted period from 2015 through 2018, the S&P returned about 7% annualized during that 4-year period. So it was still positive, but it was certainly lower than the numbers Ebrahim was mentioning, right? For the last 3 years, we've been, the S&P 500 has been annualizing at a 26% annualized return. So, if the previous cycle is any guide here, it sort of supports our outlook or our managing of expectations that returns are likely just going to be, lower than what we've experienced over the last 3 years. So Ebrahim, I know we've made a lot of comments this far, but anything to add with respect to Fed policy and rate hikes?
I concur with what you mentioned, Jeff. I think the combination of the factors that we've spoken about I think are likely to lead to a less conducive environment for markets overall. But that's not necessarily to say that we expect a market crash. We continue to find opportunities. But yes, we do think we are further along in economic recovery and a stock market recovery. And so from our risk monitoring perspective, we have entered, I think, a different phase of the market where being an active manager and taking into account risk really is far more important than an earlier phase of the market where kind of a rising tide was lifting all boats.
Yeah, and then, another series of questions, somewhat related, was around the impact that both the fiscal and monetary policy that we've spoken about has had on markets in general, especially with respect to the long-term effectiveness of markets as sort of a risk return signaling mechanism. So I thought this graphic, it's admittedly simple, purely illustrative in nature, but it appropriately sort of captures what we call the risk return waterfall that was triggered by this accommodative global monetary policy decisions post the global financial crisis. So you saw central banks taking never before seen monetary policy action. It was balance sheet expansion. It was promising to hold interest rates at zero. We saw interest rates go negative in a variety of markets. And essentially what it does is just it forces investors that would otherwise be happy and meet their needs owning treasuries, being forced to owning higher yield investments. So they go into the investment grade bond market. Those investors in turn go into the high yield market, high yield investors being pushed into the public equity market investors to the private equity market, and so on and so forth. So that sort of shift, as Ebrahim alluded to earlier, it really pushed valuations higher across all of these asset classes. So all these asset classes saw really good returns. And so that valuation expansion served as a source of return as that shift occurs. So the question really is, so what happens when the Fed removes some of that accommodation and the shift moves in reverse? I think it's fair to say maybe at a minimum that the valuation expansion across all asset classes is no longer going to serve as that reliable source of return for investors. So returns don't necessarily need to go negative as this reverses, but the prospect for higher than average returns across all asset classes as this liquidity tailwind shifts into a headwind, I think is less likely. And Ebrahim, you've touched upon this, but anything maybe you'd add with respect to the what's happening?
And Jeff, I would highlight that I think traditionally it's been viewed that as investors, clients move to kind of retirement age, they de-risk their portfolios, and that's often viewed by shifting incrementally more away from equities and more towards bonds. It's kind of been a more traditional view of looking at things. I would say often now, compared to maybe 10 or 20 years ago, we might hear from some clients saying, I can't live off the rate of return I could get in treasuries. And so you need to provide me with a higher rate of return. And as in effect, they're asking us to take higher rates of risk. And so this waterfall chart, Jeff, that you've put on the screen, I think speaks to that. It pushes people further and further up the risk spectrum. As I kind of like to explain, the market doesn't know or really doesn't care what each person's rate of return that they expect or want is. And so it's really another way of characterizing just, I think, what's taking place in the marketplace, and something for us to be very aware of. We take our responsibility for our clients very, very seriously. And we know we have many advisors on this call who have clients, and we take our responsibility to you very seriously to yes, provide strong, absolute, and relative returns. And so we certainly have every intention, as we have in the past, of providing superior relative returns, but we also realize that we don't want to take so much risk, and in doing so, deliver negative absolute returns for clients. So again, really, I think an environment that I think active managers, by looking at risk, I think have the ability to differentiate themselves.
Yeah, I mean, I think it's a great point. I mean, the last 3 years, and my guess is as we look forward, the next couple of years are going to be ones where the most tools you can have at your disposal are going to be necessary to sort of meet the challenges that markets will present. Another question, Ebrahim, came in regarding commodity prices. I know we've already discussed energy a few times here, but there's obviously a lot of commodities outside of the energy sphere as well. So how would you characterize our thoughts on commodities and our approach to investing in them?
When it comes to investing in general, we invest in a disciplined manner through our investment strategies. And so specifically when it comes to commodities, we utilize our hurdle rate strategy. So in a nutshell, if I would explain that strategy, I would say we look for environments where supply exceeds demand. And in that environment, when there's a lot of supply and very low demand, the commodity price is likely to be very low. And these commodity companies are likely to be losing money and have negative cash flow. There's really a panic in many cases in the market in this case. In that environment where there's panic and where there's fear in the marketplace, we've learned over and over again, that's the environment in which we want to add to those areas for our clients. So you saw this play out in 2020, for example. March of 2020, markets crash, commodity markets are very weak, people are in a panic, and you saw us significantly increase our exposure to commodities in certain areas like our US equity or non-US equity or multi-asset class. We went from being in line to underweight energy, for example, to being double and in some cases triple weight. But equally importantly, our strategies have taught us that once that takes place, we start to see that reverse. Supply starts to get cut back as the markets discipline these markets. Demand starts to rise. And as that takes place, as we're seeing currently, commodity prices, including energy, have gone up. These companies are no longer losing money. In many cases, they're actually making a lot of money and have a lot of positive free cash flow. And so while it's very difficult to time these markets perfectly, what we've learned over and over again is that in the environment that we're in currently, we should start to de-risk the portfolios. So we're starting to cut back on our commodity, including energy exposure. We still have some exposure, but it's meaningfully less than it has been in the past. That's not to say that we think the markets have exactly peaked. It's tough to know, but we do think the risk in these markets has meaningfully increased. So that's the continuum through how we think about these markets.
Yeah, and the one thing I'll just add is that, we don't provide forecasts or point estimates on specific commodities, but it doesn't mean we're not following them. I mean, I can speak personally. I fielded dozens of questions from clients and advisors that we work with that say, have you seen what's going on in this particular commodity market? What's your team thinking about that? And I'll go to the team that works in that group, and they'll be following those markets and they'll be finger on the pulse of what's happening there. So we're very closely following these through the hurdle rate lens, even though we are not, providing those forecasts on any particular commodity. There was one other question, Ebrahim, on the US dollar. I think the dollar was up something like 6% last year versus a broad basket of other currencies. Do we think that type of strength continues for the dollar as the Fed starts to hike rates?
Yes, so I think our expectation kind of more in the short term is for the dollar to be neutral to higher. But as we see relatively tighter monetary policy and the dollar potentially going further higher, I think they both become negative for growth. And as they become negative for growth, the support for the dollar will eventually fade as well. It'll go to a neutral territory and eventually decline. So markets are self-correcting. So to summarize our views of the dollar, yes, we could see the dollar kind of heading higher, but as monetary and other policy plays itself out, I think it's a self-correcting mechanism that will moderate the dollar over time.
And one last question here, I think not surprisingly, we were anticipating a couple questions related to cryptocurrencies. So Ebrahim, I know you and I are both on a working group here internally that is looking at cryptocurrencies. And my mind initially went to some of the companies in the gaming space that have sort of exposure and advantages from cryptocurrencies or NFTs, as well as the payment companies. But maybe just any quick thoughts that you would share around our thoughts and how we're approaching what's happening in what I'll call the digital asset markets right now.
Yeah, happy to. The question that we've gotten in the live chat was specifically related to, I think, a slide we shared earlier, slide 19, I believe, that basically spoke to $3 trillion of market cap in cryptocurrencies. And the question as to whether that's just cryptocurrencies or incorporates NFTs, non-fungible assets as well. I believe that number is actually just cryptocurrencies. And so if I could just speak to the broader theme. As Jeff mentioned, we have a group of people internally who are doing a lot of work on this area. It's really a cross-departmental, cross-functional group from different areas. So we're looking at these new kind of emerging areas very seriously. I'll call them decentralized networks, a common theme that probably runs through a lot of these areas, whether they be cryptocurrencies or NFTs or DeFi or different areas. One of the things they have in common is that they're kind of trying to decentralize things and do so with privacy. And I think, as you've generally seen, we don't have investments in cryptocurrencies in the market in our client portfolios. While we think the technologies underpinning a lot of the things that are happening here, like blockchain technologies, for example, are real. And I think that they will lead to some real creative things that take place, not just in currency kind of areas that has been highlighted, but as Jeff, you mentioned, we're monitoring what's happening in gaming and other areas. We generally have not chosen to invest in these areas. I'll highlight, if I could, from my perspective, somewhat similar thoughts maybe to what took place when there was the internet that emerged in the 90s. I think we felt at that time that there was a real technology and some real innovation would come out of it. But we couldn't fully make sense of the valuations that were being placed on many of the things back then. So we didn't invest in the late 90s. But as you know, we were monitoring them very closely. And we've had many internet investments and client portfolios ever since the tech bubble peaked. And we continue to today, whether it's an Amazon, whether it's a Microsoft, whether it be Salesforce, many different areas. So I think real things will emerge from this as well. But currently we haven't invested in it. And I would say aspects of it clearly feel frothy and speculative.
So we've referenced performance for both benchmarks and our own investment strategies throughout this presentation. We've included the specific details here on those performance metrics. As you can see, we've been managing many of these strategies for very long periods of time, in some cases for multiple decades. And the performance across our entire suite of strategies on both an absolute and relative basis has been very strong. So on behalf of our clients and attendees here, thank you, Ebrahim, for joining us here today. And thanks to you and the entire research department for the performance you've delivered for our clients.
Thanks, Jeff. And actually, if I could, before closing, maybe just address a couple other questions that I see that have come in live in the chat. One of them has spoken to the question of whether, given what we've spoken about, are we starting to see any reductions in equity allocations in our multi-asset class portfolios? And the answer to that is yes. So having been overweight equities and that having been a positive impact on performance for clients, we have started more recently to de-risk the portfolios and started lower equity levels in our multi-asset class portfolios. And then there was another question, if I could just address as well. This question asked here about, do we have a specific forecast in terms of when exactly the cycle will end and when, whether we get into a recession, whether this looks like a normal cycle. It's really hard to forecast exactly when a cycle ends or when things come to an end. So what our disciplines have led us to and what you're seeing us do currently is basically de-risk the portfolio. So when there's fear in the market, when people are in a panic, you saw this play out in March of 2020, March of 2020, 2000 as well, actually, but in both cases, a tech bubble in March of 2000, and last year what we saw with COVID happening. You'll see us increasing the risk profile of the portfolios. You'll see us adding to equities. But conversely, when the cycle plays itself out, where we are today is in a position of de-risking the portfolios, it's really hard to know when exactly a cycle ends. But our disciplines have taught us to do that consistently.
Yeah, actually, those comments remind me of the last time we were doing client seminars back in 2019, where this was the question on everyone's mind as well, trying to predict the next recession. I don't think anyone called for a global health pandemic at those times. So I'm going to close the webinar where we started by thanking everyone for their time and attention today. We are very fortunate to have you as clients and as partners, and we hope that we've delivered on our end in meeting your expectations. While the next year may prove more challenging than the one that just concluded, we hope you have confidence in partnering with a manager like Manning & Napier. We've been investing across global asset classes for over 50 years. We have the breadth, depth, and experience to take on these challenges as they come, and we come equipped with dynamic yet disciplined investment processes that allow us to avoid areas of risk and pursue more attractive investment opportunities. So as we move forward to this year, we encourage all of you to visit our website and sign up to receive our timely updates and thoughts on the markets throughout the course of the year. So once again, Ebrahim, thank you for joining us today.
Thanks, Jeff, and thanks to all of you for the trust that you've placed in us, and Happy New Year to everybody.
Take care, everyone.